that investor had before they got involved with that person. So without any further delay, we'll jump into some questions. These are questions that I've put together because we're a new show, but feel free to send us questions to our website at wallstreetversusmainstreet.com or wallstreetvmainstreet.com, and we'll try to answer those in a future show. What's our first question?
My broker recommended that I invest in a variable annuity, but I don't know what that is or whether it's a good idea.
Okay. A variable annuity is an insurance product, but unlike term life or whole life or anything like that, there's an investment component that goes into it. And obviously, I can't speak on whether or not a variable annuity in the abstract is a good or bad idea, but there's certainly some questions that would come to my mind in terms of a recommendation to buy a variable annuity. The basic functions of a variable annuity are, again, you've got this insurance component. You're going to get a death benefit at some point when you pass away. And so that's your first logical question is, do we need a death benefit? Do we need insurance? Because a lot of times what I see with a variable annuity is a financial advisor who the client wanted to invest in stocks and wanted some growth. And they say, oh, well, hey, let's buy an annuity because we can do that in the sub-accounts. And while that's true, the reality is that if that's your sole objective is to have a growth portfolio, you can accomplish that much cheaper than in a variable annuity. A variable annuity, not unlike a lot of insurance products, is very expensive. There's a lot of charges that go into it. There's usually a 4% commission to the broker, which in my experience may be the motivation why they're saying, hey, let's do a variable annuity as opposed to an ETF, which is the basis points on that is about 0.1%. So, I mean, we're talking 400% versus 0.1%. So again, it has to do with your goals. If insurance is an important thing to you, then a variable annuity can certainly have its time or place. But that's the big question is, do we need insurance? And then from there, the other things would be, do we need liquidity? There's a time and place for virtually every investment, and certainly there's a time and place for variable annuities. But where we see problems is when it's a huge percentage of somebody's portfolio. If you're somebody who's worth $1 million and you retire and you're needing $40,000 to $50,000 a year in income, and a broker recommends that you put all of your money in a variable annuity, that's probably going to become a problem. Because at some point, maybe a year, maybe 5 years, maybe even 10 years down the road, maybe you've got a health issue. Maybe you've got to help out a family member. Maybe whatever it is that you suddenly need access to your money and you can't get to it because there's huge surrender charges on annuities and they taper over time. It's usually between 7 and 9 years. But if there's some health event in the first 3 years, for example, of you're owning a variable annuity and it's all of your money, you're going to have to pay huge penalties to get at your money. And so that could be a problem. Again, if it's a huge chunk of your money and that's the recommendation and you're concerned about liquidity, then an annuity might not be the right place for you. But if it's a small percentage of your portfolio and you're desiring to have that death benefit, whether it's to pay for the funeral expenses or to leave some money to an heir, then maybe there's a place for the annuity. But again, the questions you need to be asking are, how is this appropriate given my objectives, and talk to them about costs, because of annuities, there's definitely a high expense ratio there. Talk to them about liquidity and talk to them about alternatives. Brokers, their obligation is to make a suitable investment. And that doesn't mean that the investment has to be in your best interest necessarily. It just has to be suitable for you. And lots of things can be suitable for you, but they don't necessarily all have to be in your best interest. So keep that in mind when you're dealing with your advisor. Is keep in mind that they're in sales. Their job is to sell products. And an annuity is a very popular product for brokerage industries, frankly, because they make a lot of money on annuities. So again, those are the things that I would ask if somebody's recommending that you buy a variable annuity.
And I've read a lot of bad things about annuities. So are there situations where they can be good?
Absolutely. Every investment has pros and cons, and certainly annuities have pros, and they primarily have to do with that death benefit, the insurance component. There's also some guaranteed riders that you can purchase that could get you an income stream for life. And those are usually very expensive features of an annuity. You got to be very careful there because here's the big problem with annuities. They're complex. Even for me, I deal with these things all the time, and I'll read through these contracts. It takes me a while to really figure out what the features are. And so what ends up happening is that you have financial advisors, they run into the same problems, and they might read the contract and tell you features that don't actually exist. We've had a number of cases where the financial advisor said that this annuity I'm selling you is going to pay you income for life, and that wasn't true. He didn't buy that rider. It provided an increase in their death benefit for life. So if the death benefit in year one was $100,000 and it had a 7% increase, then in year two the death benefit was $107,000. But for a lot of people, when they're buying annuities for income, the death benefit is the least important feature. They wanted that income component, and again, I've seen where brokers just drop the ball on that, and they tell the client that's what they're getting, but they're not. But if that's really what you want, that is another pro of annuities, and you just got to make sure you're getting the right features, read that contract, and go through it with the financial advisor. They're making plenty of money by selling you an annuity. They've got the time. And if they're not willing to walk you through it and answer your questions, then you're with the wrong person anyway.
And so the difference between a fixed annuity and a variable annuity is
huge difference. And they all have to do with risk. A fixed annuity literally guarantees you a return. It's going to be a smaller return than a variable annuity. The sales job on a variable annuity is that you've got this upside growth potential that comes from the sub-accounts. But that also comes with risk, just like any other investment. The sub-accounts are generally in mutual funds or stocks or bonds. And so what you're doing with a variable annuity is you're giving yourself the opportunity for some growth, but you're, of course, taking on the same risks that you would in anything else. Fixed annuity is different. They're not investing the sub-account. That's literally an insurance company saying, we're going to give you the following income for life, and you just have to look at the features of the product and figure out what you're actually getting. They're all different, but in terms of how they operate, it's incredibly different. We don't see fixed annuity cases because we don't have clients losing money in them. We do see variable annuity cases because, again, you have financial advisors who misstate the features. They get people trapped in an investment where they can't get their money out. The sub-accounts are aggressively invested. They lose money, and now here we are stuck with an annuity, and now all we really need is some income, and we can't get it.
Would you give instructions on how people can send in questions?
Sure. You can visit our website. It's wallstreetversusmainstreet.com or wallstreetvmainstreet.com. And there's a contact button on there. So just fill out the contact form, send in a question, and hopefully we'll add that in future weeks. The next thing I want to touch on is a news topic, sort of what's going on in the world right now, and something I wish investors were paying more attention to. A lot of people have heard about what's going on in Greece, and certainly the market was impacted over the last month or so because of what's happening there, and will they default on the debt? Will they not? But there's actually something that's happening even closer to home, and it's much scarier, at least to me, and that's the situation in Puerto Rico. Puerto Rico is having the same problems with insurmountable debt and an inability to pay it, and I think American investors, at least, are far more exposed to that risk than they are to Greece. But you don't hear a lot of people talking about it. We've got cases involving it already. It sort of started to unravel about a year ago, involving some UBS products. But there's more exposure there, and that has to do with some of the things that are going on now, some of the municipal bonds. And part of the problem, although I don't know that it is a problem, but this is sort of what's going to create outcome, is that Puerto Rico can't, unlike Detroit, that declared bankruptcy, Puerto Rico can't declare bankruptcy. So they can't discharge debt. They can't restructure debt. They've got to pay it, and they can't. And so you're either going to end up in a situation where the rules change, or it's going to be litigated in courts for years, but the debt holders are the ones who are going to be left holding the bag, as is often the case. And the debt holders in this case are a lot of huge bond funds that were trying to maximize return for investors, And so now they've got portfolios that are a little over concentrated in Puerto Rico because Puerto Rico, as the situation got worse there, had to increase their yield. And so instead of paying 4 or 5%, maybe Puerto Rican debt's paying 6, 7%. And so you've got bond fund advisors who are saying, okay, how can we increase our returns so we look more attractive than the other 100 bond funds that are out there? And that's what a lot of them have done, is they've over-concentrated their debt or their ownership of Puerto Rican debt. And frankly, if you're owning those funds, you're at risk that bet will pay off poorly. The ones that we've seen have to do with there's a lot of Oppenheimer funds that are in this situation. They're the Oppenheimer Rochester funds. There's various state issues of them. They've got high concentrations of Puerto Rican debt, and it's not 50%. It's more like probably 5 to 10%. But if you're owning a bond fund, your objective is to make a nice little return without losing any money. So you're going to be real shocked when there's a correction there of any kind. And so even if the exposure is 5, 10%, that's probably more risk than you were willing to take on when you bought that investment. Some other ones that we've seen that have that concentration problem: Mainstay High Yield Municipal Fund, Alpine High Yield Managed Duration Fund, and the Franklin Double Tax-Free Income Fund. Those are some bond funds that we've seen through our research that may have more Puerto Rican debt than they need. So that's something that I would caution investors on in terms of what's happening in the world right now. Generally speaking, I would tell people, don't chase yield. There's always a correlation between risk and return. If you've got a bond fund that's paying, 1 to 2% more than most, there's a reason. And in this case, that's what we're seeing. Again, we're not getting, we don't have clients who are buying these things or calling us yet because they haven't lost the money yet. But I'm concerned because I see the writing on the wall, and I think in the future that may become a problem. So that's news of the week, something to keep in mind.
Fujiyama as Vero's favorite Japanese steakhouse, sushi bar, and hibachi grill. Now Fujiyama announces lunch and dinner Asian fusion, Chinese and Thai, with all day, all night, $4 popular cocktails too. Early bird dinners Monday through Friday from 4:30 to 5:45. Kids eat free all day Sundays with a paid adult. Place your order online at FujiyamaVeroBeach.com. Fusion comes to Fujiyama in the Marshalls Plaza, Route 60, Vero Beach.
Hello, I'm Chris Hudman, formerly of Bugmaster, now co-owner of Compass Pest Control. CompassPests.com. Compass provides a complete range of services, including lawn and landscape, termite prevention, and structural pest control for both residential and commercial clients. Find out why friends and neighbors are choosing a new direction and moving to Compass Pest Control. Call Compass at 772-413-1647 or visit CompassPests.com.
Today in business, you truly can't do business without a professional website. That's where Cobalt Creative comes in. Tom Nangle, president of Cobalt Creative, makes sure to take care of your search engine optimization and hosting. Cobalt Creative will also tie in all your important social media needs as well. Call Cobalt Creative today. Get one page on your website absolutely free just by making the call. Call 772-333-0006. Cobalt Creative Company, an iTex trading community member. Your iTex dollars are welcome.
Let me just get.
Hold on. Do you have the camera?
Well, should I be seeing it on the screen? Is it still on? If it's not, I mean, I can do it through the viewfinder, but I just want to make sure it's on.
This is Galvin's camera, so the answer to your question is I have no idea.
Fair enough.
Yeah, just do it.
Okay.
If I can get just a level on you.
I think you just want to test the vocal on that.
Yeah, no. I'm just waiting. What do you want?
That's all. Okay.
Oh, that was good?
Yep.
Oh, okay.
Are you ready?
I'm ready.
Okay, here we go. And we're back with Wall Street versus Main Street with Dax White.
Welcome back. The next topic I want to talk about, because again, the goal here is to arm the public with information to help them. And something that we see a lot in our practice is some confusion on what is the financial advisor's obligation to clients. Because most clients that we speak with believe that the financial advisor has a fiduciary duty to them. And while that can be the case in some situations, generally it's not. And certainly I can tell you that brokerage firms fight that tooth and nail in arbitration hearings and argue that they have no fiduciary duty to clients. And so there's this disconnect between the advertisements that you see on TV where they say, trust us, and we've got this huge track record and give us all your life savings, and the obligation that they actually believe they have to clients. And the standard they believe they have is what's called a suitability standard. And essentially what they would argue is that their obligation is to make an investment that is suitable for you based on your investment objectives, your income, your net worth, your assets, and your investment experience. And as long as whatever they're recommending is suitable and falls in line with those objectives, they would argue that that's where their obligations to you end. And that can be very different than recommending something that is in your best interest, because that's what a fiduciary duty is. A fiduciary duty is literally to put the interest of your client ahead of your own. And unfortunately, that can be a huge difference between suitability, because they might say, oh, well, I found this mutual fund that I believe is suitable based on what they're looking for, but that mutual fund might pay them 1% more than another investment that's actually better for them and more in their interests. And that would be a fiduciary duty standard. So that's a huge problem that we see. And it's certainly information that investors need. Ask your financial advisor, what's your obligation to me? Do you have a fiduciary duty to me? Put it in writing. I want to make sure that if you're recommending a product to me, that it's in my best interest and not in yours. And too often we see, that the suitability standard can let people down. And it's actually up for discussion in the legislation right now. So perhaps the standard will change. I would tell you that I'm doubtful. And unfortunately, that has everything to do with big money lobbyists that brokerage firms have. They're spending a lot of money to make sure that the new fiduciary duty rules don't pass. But if you're concerned about it and you want to reach out to your congressman or congressperson, I would absolutely suggest that you do that, because I think they need to hear from people. Because if we could get a uniform fiduciary duty standard that's more in line with clients' expectations, I think that could go a long way towards cleaning up the brokerage industry. Because again, too often we have clients who believe that my broker had a fiduciary duty to me, that, I trusted them, they were looking out for me, and the standard is not necessarily that. What's interesting to me from a practical standpoint is again, brokerage industries will argue to the death that they have no fiduciary duty to you, but it's actually one of the easier things at hearings for us to prove. And I picked this up from a defense lawyer years ago, and I really like this practice tip. But at hearings, we literally will just ask the financial advisor, do you put your interests ahead of your clients? And if they say yes, I mean, that just makes them look terrible. because of course you've got arbitrators that are sitting there going, oh man, I can't believe that they would do that. And if they say, no, of course not, which is typically how they'll testify. No, I always put my clients' interests ahead of their own. I literally slap the Black Law Dictionary in front of them and ask them to read the definition of a fiduciary duty, because that's what it says. A fiduciary is somebody who puts the interests of their clients ahead of their own. So if you just ask them, it's hard for them to testify otherwise, but their lawyer will get mad and say, well, you're asking him to make a legal conclusion. And I say, no, he's simply testifying as to what he thought, whether or not he actually put their interests ahead of their own. So that's sort of our practice tip or topic of the week, something I wish investors knew. Next, I'm going to bring on a guest to give their perspective on brokerage industry, and this is actually somebody from my office. So he's basically required to be here, but his name's James Galvin. He's a securities attorney. His background is that he worked at the University of Miami Investors' Rights Clinic, which is funded by FINRA, and they handled small FINRA arbitration claims on behalf of investors, claims that lawyers wouldn't take on because of the size of the case. He's also worked at the SEC, but more importantly and more relevant to our discussion today is that before he went to law school, he was a financial advisor. And so I thought it would be important, or at least interesting to people, to bring him on, and let's get his perspective on working in the brokerage industry. So welcome, James.
Hey, how are you today?
Doing great. Tell me a little bit about your first year as a financial advisor, and let's not talk about the firm because I don't think that's relevant. I certainly, having talked to you about this in the past, think your experience is pretty consistent. So I don't think this is a firm-wide or firm problem. I think this is an industry problem. Tell me a little bit about that first year. How they have you find clients? What did they tell you to sell, etc.?
Your first year is pretty insane. It's all about trying to, are you going to make it or are you not going to make it? It's almost a club mentality. In order to make it, and basically by that I mean continue being employed there, you have to generate enough commissions so that you're meeting your quota. And really that involves getting in front of as many people as possible and, selling products to them that are going to generate enough commission for you to stay employed. Typically your first year, you're not picking your own product mix. It's getting picked for you. And that may or may not be a good thing because all of your time is really spent trying to get clients. And so they're not really teaching you necessarily what the different products are, which one's more appropriate for somebody versus another. And as far as getting clients, it can be anything from, obviously they're going to tell you to get all of your friends and family to come in, referrals from them, all the way to doing lunches, where you just bring lunch to offices and basically give a short spiel to everyone at the office and tell them what you do and get them to come in. And whenever they come into the meeting, you're not the only one in there. I mean, your manager is going to go in there with you. He's going to sell the products to them because, again, most people don't know what they're doing.
Tell me about that. Before they sent you out to these seminars, what training did you have?
Really, the majority of it is sales training. They're going to teach you different ways to, get in front of people. You're going to memorize scripts. Lots of scripts. There's going to be the script that you're going to use on the phone when you call somebody the first time. There's going to be the script that you use when you go to do one of the lunches, or a script that you're going to use for the first meeting. There's going to be a script for every single one of the products that you are going to be selling to them. And it's basically something that's written with the sole purpose of hitting on all the reasons why they would buy it from you. And you're going to rehearse them over and over again. And
you mentioned that you didn't really make a lot of selection on the products that you would sell. What stuff did your firm have you selling?
Well, everybody had to have some type of insurance. So basically everybody has a need for life insurance and disability insurance. So whether or not that was the case or not, that was what you were told to sell everybody. Variable annuities, real estate investment trusts, Class A mutual fund shares, all the products that basically pay a upfront commission versus doing something like a fee-based account that's going to take a percentage of the assets over every year.
And this was all to meet that quota, because again, if you don't sell enough, you're out.
Right. Yeah. If you want to be one of the people that are going to make it and have this life that they, paint for you, then you've got to hit that quota.
Okay. Thanks, James. Appreciate you coming on. Again, you've been listening to Wall Street versus Main Street. Each week, we're going to try to shine the light on some of the tricks of the brokerage industry and arm you with information that you need so that you can have a better relationship with your financial advisor. For more information, visit our website, wallstreetversusmainstreet.com. We've got lots of resources there, information to help you. And thank you for listening.
The views expressed by the participants of this program are their own and do not represent the views and are not endorsed by the White Law Group, its officers, directors, employees, agents, representatives, shareholders, none of its subsidiaries, and none of the content should be considered legal advice. And as always,